Welcome to Talk Tickers. Today, we're breaking down Flutter Entertainment's Q3 earnings. And let me tell you, this was one of the most complex reports of the season, absolutely packed with contradictions that left a lot of investors just scratching their heads. So let's dive right in. So here's the big puzzle we need to solve. On one hand, Flutter delivered a massive, over 100% beat on their adjusted earnings, but they also missed on revenue, and they cut their guidance for the full year. So what did the market do? Pretty much nothing. The stock basically flatlined. What is going on under the hood here?
All right, to figure this out, we've got to start with the headline numbers, because believe me, that's where all the confusion really kicks off.
Okay, just look at this contrast. It's pretty wild. You've got revenue coming in at almost $3.8 billion. That's up a really healthy 17% from last year. But it still missed what analysts were expecting. Meanwhile, adjusted earnings per share came in at $1.64, more than doubling the consensus estimate. But then you look at the official GAAP number, a loss of almost $4 a share. A beat, a miss, and a huge loss, all rolled into one. So how in the world do you reconcile that? Well, the crucial thing to understand here is the difference between the GAAP accounting and their, let's call it, adjusted reality. The company reported a GAAP net loss of $690 million, but on an adjusted basis, they were actually profitable. And that huge gap? It's all because of some very big one-off charges that weren't related to cash. And here are the two main culprits. First, a massive $556 million non-cash write-down on their business in India. That was thanks to a sudden regulatory change that basically shut down real money gaming there. Second, another $204 million in charges connected to a new deal with Boyd Gaming. So once you strip these weird one-time items out, that massive adjusted earnings beat starts to make a whole lot more sense. Okay, so now let's get past the accounting and look at the actual operational story. Because beyond all the adjustments, Flutter's performance was really a tale of two completely different segments, especially in that all-important US market. And wow, this chart just lays it all out, doesn't it? In the US, the iGaming business, the online casino stuff, was absolutely on fire. Revenue soared 44%. But then you look at the sportsbook, the part of the business everyone focuses on, and its revenue actually declined by 5%. So what happened there? It wasn't a demand issue. It's not like people stopped betting. No way. The problem was just plain old bad luck. Or maybe good luck, if you are better. Management basically said that a bunch of NFL results went the customer's way, and that cost them about $45 million. You know how it is. When all the favorites win and the popular bets hit, the house doesn't do as well. It's a margin story, not a growth story. And hey, while all that drama was going on in the US, the international division quietly put up a really strong quarter, with revenue growing 21%. This was mostly driven by some smart acquisitions they made, especially in Italy and Brazil, which really shows their global diversification strategy is starting to pay off. But the biggest news from the earnings call wasn't really about the past quarter. No, it was about a major and very costly new strategic pivot. A huge gamble on a brand new product they're calling FanDuel Predicts. So, what are prediction markets? Well, think of them like a stock market, but for real-world events. They let people trade on the outcomes of everything from sports games to financial news, even pop culture. And here's the really crucial part. They can operate in states that haven't legalized traditional sports betting yet. This is Flutter's big answer to competitors like Kalshi, and it's their way to reach millions of potential new customers in untapped markets like California and Texas. Now, a big move like this, it comes with a hefty price tag right out of the gate. Management expects to spend $40 to $50 million in this quarter alone just to get FanDuel Predicts off the ground, which is going to directly hit their bottom line. And that's just the start. They are planning to pour another $200 to $300 million into this project next year. So yeah, this isn't some small experiment. It's a massive strategic investment designed to go out and totally dominate a new market before it even gets going. And the CEO, Peter Jackson, he made their intentions crystal clear on the call. He said the opportunity is significant and our aspiration is to be the clear market leader. This right here explains why they're willing to spend so aggressively, and it's a huge piece of why they had to cut their guidance. So let's tie all of this together. We've got a mixed quarter and a massive new spending plan. So why are investors so hesitant? Well, it really comes down to the company's revised guidance and some growing risks you can see right on their balance sheet. Management had to lower their full-year forecast for a whole bunch of reasons. It was kind of a perfect storm of bad news. You had the unlucky sports results we talked about, the brand new investment in FanDuel Predicts, the regulatory shutdown in India, and the impact of a higher tax rate in Illinois. It was just one thing after another. At the same time, the company's debt level has jumped a lot. Their net debt is now 4 times a key measure of their annual earnings. To put that in perspective, it was just over 2 times at the end of last year. That is a lot more risk for investors to digest, especially when a company is about to start burning through cash on a new project.
And you have to view all this in context. The stock was already struggling coming into the report. It was down 20% over the last 3 months, trailing its competitors and the broader market. So a complex report with a guidance cut was just never going to be the thing that sparked a big rally.
So what does this all mean for the next quarter? All right, here's our take on what you should watch for, our official rating on the stock, and a potential trade idea. So looking ahead to Q4, here's what we expect. First, sportsbook margins should bounce right back as those weird NFL results normalize. Second, the incredible momentum they have in iGaming should continue. But really, all eyes, and I mean all eyes, are going to be on that December launch of FanDuel Predicts. Does it get any early traction? And does management actually stick to their disciplined spending promise? Based on all this, we're rating the stock market perform. Look, the bull case is clear. You've got stellar iGaming growth and the massive long-term potential of these prediction markets. But you have to balance that with the very real risks of higher debt, the challenge of executing a brand new product, and a more competitive environment. For now, we see it as a hold.
But for those of you looking for a trade, here's an idea. The thesis is basically a bet on long-term optionality versus all this near-term uncertainty. So instead of buying the stock outright, you could consider long-dated call options, going out 18 to 24 months. This lets you capture that massive potential upside if FanDuel predicts as a home run, or if maybe M&A comes into play, while strictly defining your downside risk in what is probably going to be a volatile stock for the next few quarters.
And that wraps up our breakdown of Flutter's quarter. And of course, just a reminder that this is not financial advice. Thanks for watching Talk Tickers.